Retiring on dividends is a great way to enjoy your golden years because it allows you to live off a steady stream of passive income. This mitigates the sequence of returns risk that comes with depending on capital appreciation from stocks to fund your retirement. Hey everyone, this is Samuel. I run High Yield Investor, the highest ranked investment group on Seeking Alpha, and I specialize in dividend investing. Before I get into discussing Enterprise Products Partners, I wanted to ask you to please give this video a like and subscribe to my channel. I just started on YouTube to share my unique approach to dividend investing with a larger audience, and I need your help to make it a success. Thank you very much. The forward outlook for the broader stock market is perhaps weaker on a risk-adjusted basis than ever before, given that the S&P 500 is currently significantly overvalued based on numerous metrics. And with growing uncertainty about when or even if interest rates will get cut, prominent businessmen like Jamie Dimon have warned that interest rates could actually rise even further. On top of that, geopolitical tensions are soaring that could potentially spiral into a major global conflict and even plunge the world into a recession or depression. However, if instead of counting on continued appreciation in the S&P 500 to fund your retirement, you are enjoying a steady stream of dividend income, your probability of enjoying a lengthy and low-stress retirement is much greater. This is because dividends come from underlying profits, which are much less sensitive to wild swings in market sentiment than capital appreciation is. Moreover, if the cash flow is generated by a very defensive business model with a stable cash flow profile, it is much more likely to withstand geopolitical and macroeconomic headwinds. For this reason, I think building a passive income dividend portfolio is a superior way to plan for retirement than just buying broadly diversified index funds or investing in high-flying but low-yielding growth stocks. In particular, I look for stocks that have defensive, enduring, durable business models, strong balance sheets, safe and growing dividend payouts, and high current dividend yields. If I could pick just one stock to retire on that fits these four criteria to as close to perfection as possible, it would be Enterprise Products Partners. In this video, I will explain why. The first reason I really like Enterprise Products Partners is that it has a defensive and durable business model. With Enterprise Products Partners' strategically located portfolio of high-quality assets, significant diversification, and strong cash flow profile that largely comes from lengthy contracts, along with its proven track record of weathering and consistently generating double-digit returns on invested capital through numerous market cycles, investors can count on to continue generating stable cash flows for years to come. The second reason I like Enterprise Products Partners is that it has a strong balance sheet. With the best credit rating in its sector and an A- credit rating from the S&P 500, along with a very low 3.0 times leverage ratio and a nearly 19-year weighted average term to maturity on its debt, it has a very strong balance sheet. Moreover, a whopping 48% of its debt does not mature for 30 or more years, and 80% of its debt does not mature for 10 or more years, with 87% not maturing for 5 or more years. With $4.5 billion of liquidity as well, it is very well positioned to weather any headwinds that come its way, and its dividend distribution should not be threatened even if a severe economic downturn should occur. In fact, on the latest earnings call, management emphasized Enterprise Products Partners' substantial capacity to buy back units if a significant market dislocation should occur. The third reason I like Enterprise Products Partners is that it has a safe and growing dividend payout. With a 1.7 times distributable cash flow coverage ratio, as well as some inflation-linked escalators on its pipeline contracts and a very attractive growth pipeline, it is well positioned to grow its distributable cash flow as well as its distribution per unit for years to come, giving additional capacity to return capital to unit holders as well in the coming years when more of these projects come online. Meanwhile, it has a quarter-century streak of growing its distribution year after year, and it has been growing its distribution at a rate of around 5% per year in recent years. As a result, analysts are expecting it to grow its distribution at a 5.1% CAGR through 2028, alongside a projected distributable cash flow per unit CAGR of 5.6% over that same period. As a result, investors not only can take confidence in the safety, but also the expectation that it will grow at a rate that is expected to exceed inflation for years to come. The final reason that I like Enterprise Products Partners is that its current yield is very attractive, standing at 7.6% on a forward basis. This means that if you retire with a $1 million portfolio, you'll be generating around $75,000 per year in passive income that will also grow at a rate that comfortably exceeds inflation for years to come. Not only that, but this passive income is tax advantaged since MLP distributions are typically classified as return of capital and therefore are deferred on taxes until the sale of the units. And if the units are held until death and passed on to peers at a stepped-up basis, those capital distributions become effectively tax-free. This makes them particularly useful assets for retirees who may only need to hold these units for a few decades. Given the defensive and durable posture of Enterprise Products Partners, as emphasized on its latest earnings call by management, its best-in-class balance sheet, and its strong cash flow generation, I expect its balance sheet to come even stronger in the years to come. Along with the very conservative distribution coverage and the low-risk recession-resistant business profile, Enterprise Products Partners makes for perhaps the ultimate retirement passive income vehicle. As a result, if I could only own one stock to retire on, it would be Enterprise Products Partners. What do you think? Let me know your thoughts on Enterprise Products Partners and share your favorite stock to retire on in the comments section below. Also, if you found this video helpful and would like to hear more detail in my next few videos on how I built my high yield portfolio to beat the market, as well as my thoughts on some leading high yield stocks, please like the video and subscribe to my channel. I'll be sharing more insights on dividend investing and how to build a better passive income portfolio in the coming days and weeks. Thank you for watching, and see you next time.